Equity markets raced higher as the fear of missing out set in during the second quarter of 2023, led by the tech-heavy NASDAQ up over 30% on the year. Returns were concentrated in a handful of mega-cap technology stocks, driven by excitement over artificial intelligence, including the launch of ChatGPT. This concentration of returns has created a narrow stock market, with Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla up 30 to 180% compared to the S&P 500, which was up only 15% through the first half of the year. These 7 companies now make up nearly 30% of the S&P 500, which is a market capitalization weighted index. Looking at the difference in performance between the S&P 500 and an equally weighted basket of the same 500 stocks, the former has outperformed by nearly threefold. Though the term artificial intelligence has been around for decades, it was not until the last 2 quarters that mentions in earnings calls began to take off. The launch of ChatGPT late last year showed how far AI has come, and companies across the board, from technology to grocers, wanted in on the hype. The rally in the stock market this year has not yet been supported by increased company earnings, pushing the forward price-to-earnings ratio to 19.4 times, well above the 25-year average of 16 times, and tipping near levels we have not seen since the beginning of 2022. Much of the optimism surrounding the stock market rally this year is due to the rapid decline in inflation, as measured by the Consumer Price Index, or CPI. After hitting a peak of 9% last year, CPI has come down, with the most recent reading coming in at 3%. However, core CPI, which excludes the volatile food and energy components, remains stubbornly high at 4.8%. The U.S. labor market is still strong, but is showing some signs of loosening, with job openings at 10 million, down from a peak of 12 million. This should translate into slower wage growth, which could help reduce inflation, particularly in the service industry. While the equity market paints a picture of optimism, the bond market is telling a different story. At the end of 2021, the yield curve was upward sloping, indicating that the bond market was expecting a period of economic expansion. As the Federal Reserve raised interest rates throughout 2022, the short end of the curve was pushed up to a point where short-term bonds now yield more than long-term bonds. This is known as an inverted yield curve. One relationship that is closely tracked is the difference between the 2-year yield and the 10-year yield, commonly known as the 2-10 spread. If you graph the relationship between these 2 points over the last several decades, an interesting pattern emerges. The line dips below 0, indicating that the yield curve has inverted, about 6 to 18 months before every recession, shown here in shaded bars. The current inversion stands at about 1%, which is the deepest and longest inversion that we've witnessed since the 1980s. The Fed has maintained the higher for longer mantra, saying that more rate hikes are necessary to tame inflation, and that they plan to keep rates high until it subsides. However, the market is pricing in rate cuts in the first half of next year. Optimists believe that the healthy labor market and strong consumer could usher in a soft landing, a scenario where inflation comes down without causing a recession, allowing the Fed to reduce rates. However, after one of the fastest rate hike cycles in history, from 0 to over 5% in about a year, it's likely that the effects of monetary policy are just starting to be felt now. A higher cost of capital and tightening lending standards should weigh on companies' ability to hire and consumers' ability to borrow and spend. The longer inflation stays above the 2% target, the higher the probability that the Fed's aggressive rate hikes will result in a recession and eventual rate cuts. In this environment, we favor high-quality companies with proven revenue streams and low valuations, which should hold up better in the event of an equity market repricing. We're also beginning to extend duration slightly in the bond market allocations, supplementing short-duration treasury ladders that we've constructed in client portfolios by adding intermediate-term investment-grade credit to pick up additional yield.